Hey everyone, it's Jez Financial, and today we're diving deep into the mind of Robert Kiyosaki, the author of the best-selling personal finance book, Rich Dad, Poor Dad. Kiyosaki's unconventional wisdom has inspired millions to rethink traditional money management and embrace entrepreneurship and investing. Today we'll be taking a page from his book, diving into his real estate investing playbook, and understanding the strategies he uses to build wealth. Now, you've probably heard the typical retirement advice: work a 9 to 5, save a portion of your income, invest in a 401k or an IRA, and hope for the best when you retire. But what if I told you there's another way, a way to take control of your financial future and potentially retire much earlier? Kiyosaki believes that the traditional retirement plan is a recipe for mediocrity, and instead advocates for building wealth through assets like real estate. In this video, we'll break down 3 proven real estate investing principles from Robert Kiyosaki that can help you build a solid retirement plan that doesn't rely solely on the stock market or a traditional pension. We'll explore how these principles can help you generate passive income, build long-term wealth, and achieve financial freedom. Whether you're just starting or already have some investments, these principles offer valuable insights to level up your financial game. One of Kiyosaki's core principles revolves around the idea of cash flow. He constantly emphasizes that the wealthy don't chase appreciation, they seek cash flow. Think about it. What's better than receiving a consistent stream of passive income from your investments? That's the beauty of cash flow. It's about generating money month after month, regardless of whether the market is up or down. The idea is simple: you buy an income-producing property, and the rent you collect from tenants covers your mortgage payments, property taxes, and other expenses. Ideally, you want to have some cash flow left over after covering all your expenses. That's your profit. This is fundamentally different from traditional retirement planning, where you're often at the mercy of market fluctuations. Let's say you buy a rental property for $200,000 with a 20% down payment, meaning you're taking out a mortgage for $160,000. If you can rent out that property for $2,000 per month, you're bringing in $24,000 per year in rental income. After accounting for your mortgage payments, property taxes, insurance, and other expenses, you could be left with a healthy monthly cash flow. And the best part, this cash flow is relatively consistent and predictable. You're not relying on the stock market to go up or a company to perform well. But cash flow isn't just about covering your expenses, it's also about building long-term wealth. That consistent stream of income can be reinvested to grow your portfolio even faster. You could use it to make a larger down payment on your next rental property, pay down your existing mortgages faster, or even diversify into other asset classes. Remember, the name of the game is to create a system where your money works for you, not the other way around. By focusing on cash flow generating assets like rental properties, you're essentially building a safety net that can provide financial security and peace of mind. Kiyosaki is a huge advocate for using other people's money, or OPM, to build wealth, especially in real estate. He argues that the rich don't get rich by using their own money, they use leverage to amplify their returns. And in the world of real estate, leverage is king. Think about it: when you buy a property with a mortgage, you're essentially using the bank's money to acquire an asset that has the potential to generate income and appreciate in value. Let's say you buy a $300,000 property with a 20% down payment. That means you're putting down $60,000 of your own money and borrowing $240,000 from the bank. Now, let's assume that property appreciates by a modest 3% per year. That's a $9,000 increase in the property's value. Here's where leverage comes in. Because you only put down 20%, your $9,000 gain represents a 15% return on your initial investment of $60,000. That's significantly higher than the 3% appreciation you would have earned if you had paid for the entire property in cash. Of course, leverage comes with risks. If the property value declines, your losses are also amplified. But Kiyosaki argues that by understanding how to manage risk and carefully selecting properties with strong cash flow potential, you can mitigate these risks and use leverage to your advantage. And it's not just about traditional bank loans. Kiyosaki encourages exploring creative financing strategies such as partnerships, private loans, and even seller financing. For example, you could partner with someone who has the capital but not the time or expertise to manage a rental property, or you could negotiate seller financing, where the seller acts as the bank, allowing you to purchase the property with a smaller down payment and potentially more favorable terms. Your wealth. So, there you have it. Robert Kiyosaki's 3 proven principles for building a rock-solid retirement plan through real estate investing: prioritize cash flow, leverage other people's money, and master the art of tax optimization. By implementing these strategies, you can potentially achieve financial freedom and retire much earlier than you ever thought possible. What do you think about Kiyosaki's approach to retirement planning? Let me know in the comments down below. I'm curious to hear your thoughts. If you're new to the channel and found this video helpful, make sure to hit that subscribe button and turn on notifications so you don't miss out on future videos. And if you want to learn more about building wealth through real estate, I highly recommend checking out my previous video on house flipping. It's a great way to generate quick profits and gain valuable experience in the real estate market. The link is in the description below. Thanks for watching, and I'll see you in the next one.